the expected gains are to continue today. At least that's the expectation after a positive close yesterday, the JSE gaining the most in more than 2 months yesterday, firming along with its global peers on the bets that the United States Federal Reserve will pause interest rate hikes after the country's consumer inflation continued to slow. Now, independent analyst is Jimmy Moyaha talking to us about how the markets are faring in early trade. Jimmy, good morning to you. Good to have you. Let's start with that quick overview of how the JSE is faring this morning after that rally yesterday.
Good morning, Willie. Morning to the viewers. The JSE is sort of flat after being up more than 10% on the top 40. We're seeing that some of the reversals or some of the losses that we did suffer around Monday on the resources side seem to be somewhat reversing. We've got resources trading up in early trade about 0.25%, financials up just over 0.1% as well. But you're seeing that the overall sentiment is very much a wait-and-see approach because, as you rightly mentioned, that interest rate decision is very, very important today. It has a lot of impact. It's perceived to have a lot of impact on a couple of things. The oil side of the picture as well, expected to be affected by that interest rate decision. So we saw that the CPI number from the US came in yesterday slightly better than expected, and the anticipation there is if the US is to pause on that rate hiking cycle, what will those implications be for the rest of the United States economy, but also for other markets around the world? And to that effect, you're seeing that the top 40 at this stage is sort of a little muted, but you're seeing that the rand is continuing to show signs of strength. Rather, it's up about 0.5% against the dollar, sitting at about 18 rand 53 against the dollar, sitting at around 23 rand 30 against the pound, and about 19 rand 90 or 20 rand against the euro. Stronger about 0.5% across all three of those majors.
Let's pick up on the oil. You've touched on it, inching lower today in terms of the pricing, and the industry data showing an unexpected rise in those U.S. crude stocks. This signals a weak demand to markets who are already worried about a recession here, Jimmy. What's going on here?
So the oil picture is quite an interesting one. If you remember, coming out of sort of when we started to look at global recoveries and economic recoveries, a lot of what the IMF and the World Bank were saying were pinned around Chinese recovery in the hopes that Chinese recovery would lead global recovery and global growth forecasts for the year. That has since not happened. So data coming out of China has shown that the Chinese recovery isn't where we had pegged it, and we've seen manufacturing and other data points come in a little lower than expected. And we are still set to see a couple more data points coming out of China. And that's where a lot of the concern is sitting at the moment. Is the slowdown in demand is very evident from the U.S. crude oil inventory numbers that have been reported. But coupled with that, we need to see what the demand picture looks like from a Chinese perspective, because that'll speak to a more global demand. We've already seen that the OPEC plus countries have agreed to production cuts. They've increased quotas. So guys like Russia are allowed to produce a bit more in this time, but they're increasing overall supply into the market, or decreasing, overall supply into the market in an effort to control that price and move that price a little towards that $80 a barrel. So we'll have to wait and see what, number one, the U.S. data point comes out as, because if the U.S. says we're going to halt interest rates, then the expectation is that that's going to give the market a bit of fuel to potentially see if demand starts to pick up, and that will then obviously drive oil prices. But if the U.S. continues on their rate hiking cycle, that could continue to constrain demand. And then we still have, as I mentioned, those data points out of China that will then reinforce whether Chinese demand is picking up where it should be, or whether we're still going to see a bit of a slower recovery from that perspective.
Yeah, let's talk company news. The SPAR Group publishing its interim results for the 6 months, which ended on the 31st of March 2023. How are their numbers looking?
So they reported strong numbers. They reported a growth in turnover of about 7.9%. This was off the backdrop of some increased revenues from their Southern African divisions as well as their Northern Ireland divisions. They did see some declines in their Swiss division, but overall the Swiss businesses or the Swiss retailers are under pressure on that side in any way. So that is not too much of a surprise from that perspective. What is quite a surprise is that their operating profits were down about 17.5% as compared to last year, and this resulted in their diluted headline earnings per share coming in a little lower. Spot did say, though, that they've made a couple of changes and that sort of thing, and we know they've had governance issues in the past, and it looks as though they've gone through a couple of steps to remedy those governance issues, including, I think today there was an announcement that one of the independent non-executive directors is the deputy chairperson of the board. So they've made governance point to try and restore confidence investors around their governance. But as I said, their numbers came in. Revenues were higher from most of the business units. And they can say that they're seeing it from their Polish unit, which still is their own region, is sort of loss-making at the stage if we look at profit tax loss or tax. Ireland and Switzerland and Southern Africa are profit-making. The Polish business is fairly new related to the other business areas of the group. So hopefully we do see that improvement continues and it does turn profitable soon.
All right, that line to you, Jimmy, not holding steady. Let's perhaps quickly conclude with Naspers publishing a trading statement for the year, which ended on the 31st of March, 2023. Talk us through their performance.
So Naspers is saying that we're going to have to wait until the 27th of June to see those final results. But what they have alluded to is the impact of their strategic decisions to sell some of their Tencent holdings. We know that they had about a 29% holding in Tencent. They have reduced that down to 26%, and they've used those proceeds immediately to sort of buy back Naspers shares in an effort to increase the shareholder value. And they've said that in doing that, it's created about $29 billion in shareholder value that they've been able to return to shareholders. They have said that the resulting impact of having lower contributions from Tencent of equity distribution or a dividend distribution has affected their earnings per share and their headline earnings per share. We're anticipating that earnings per share is going to be down anywhere from 49 to 56 or 57 odd percent. Headline earnings per share down anywhere from 75 to 82%. But as I said, we'll have to wait until the 27th of June to see some of those other moving parts. One of the other things that they did obviously highlight is around their discontinued operations. They've successfully exited their Russian classifieds business, Avito, and they're also in the process of finalizing the sale for their OLX Autos business. They said that they do want to be in that autos business for a while, so they've classified both as discontinued operations going into the new financial year, and they've finalized the Avito sale from the Russian side of it, so we'll have to see how that pans out in terms of numbers, and then the discontinued operation, we'll see how long that they're going to hold that onto the book and at what valuation at this stage.
Jimmy Moyaha, thank you very much for that markets update. Independent markets analyst there.